Are you a working professional but struggling to balance the workload of your career, family, obligations, and preparing for your financial future? If so, this podcast is for you. You've spent years learning your craft, and now it's time to focus on your financial future. This podcast will teach you what you need to retire wealthy and happy. Let's dive in.
Welcome to the Retire Wealthy and Happy podcast. We created this podcast to provide financial tips and tricks to help you build up your passive income and also provide methods that you can use to protect your wealth so that you can plan a better future for yourself and your family. We're grateful to have this podcast sponsored by Monument Real Estate Capital. Monument Real Estate Capital, helping you retire 10 years early through real estate investments.
Hello, and welcome to the Retire Wealthy and Happy podcast. Today, I'm co-hosting with Anthony Esparza, and we're glad to have Ben Lakey on as our guest speaker. We're going to be interviewing Ben, talking about everything from development to self-storage to building short-term rentals in the United States and on islands. Hello, and welcome to the podcast, Ben.
Hey, Roger, thanks for having me. Anthony, it's great to be on with you.
Yeah, great to have you on, Ben. Excited to jump in and learn a few different things from you guys and see where we go down this rabbit hole today.
Awesome. Ben, why don't you give us a little introduction and tell us about yourself and what you've done in your career?
Sure. I flipped my first house in 2002. And at the time I was studying at the U, was studying finance and accounting. And at the time, I think the average income for a grad of the University of Utah's program made about $34,000 or $35,000 a year. And I flipped the house with my brother, who was also studying there, computer science. And we made a decent chunk more than that in about a month. And, I just realized that school was on the back burner. I had a great time and I had some construction experience. So I actually supervised the crews on the job site. And I went from there. I flipped a lot of houses. I think about 150 houses I flipped. I did some wholesaling and eventually went to BYU Law School and switched that into land development. And since that time, so my first land development was 9 lots, just residential lots that we sold off. My second one and third one were both flips that me and a partner bought and subdivided off one lot. And I very quickly realized that it was more lucrative, less stressful, and more fun to me than was flipping. And so since that time, I've done one flip. That was 2017. And my fourth development was 32 lots. And my fifth development was about 1,600 lots. So you can scale really well in development in a way that is very difficult to do with house flipping and wholesaling.
That's awesome.
That's pretty awesome. I had a question regarding, so you kind of started out going to college, you transferred to grad school. I know Roger mentioned something before the podcast that you are wrapping up a 20-year career. So my question was, were you always in house flipping and development solely, or did you have something on the side and this was kind of your side hustle, your side business? How did that look?
I enlisted in the Army in September of 2000. And so I was already enlisted at the time and just in the National Guard. And so I was just doing it part-time, 1 weekend a month, 2 weeks a year. And the only other job that I took throughout my career is after I graduated law school, I practiced law for myself. And I maybe did $500,000 or $600,000 worth of legal work over a couple of years, and just rolled straight back into full-time investing. Because when I was in law school, it was a very part-time.
Hmm. And so law school is more of like a passion or an interest that you kind of just kept rolling with, and then still main focus was on the real estate investing and flipping and development type stuff.
I went to law school in 2010, and that was a very hard time to make money in real estate at the time. And I got a full tuition scholarship with a stipend to law school. And so I thought, hey, now's a really the best time I'm going to have to take advantage of something like this. And it's worked out really well. It's given me some really good formal education and ability to really leverage my knowledge and network to develop, because development is very law heavy. There's a lot of code with every municipality and every state. And it also worked out very well because my current business partner is somebody I went to law school with. And so it's worked out really great.
Nice. If you had to go back, or say you went through the kind of the 08, 09, 2010, when the real estate market wasn't good, eventually that may be bound to happen again. But if it does happen, is there something you learned from that era where it was hard to make money in real estate, where you could pivot and do something different now and still succeed with real estate when the market's down like that?
The first thing I would say is sell your dogs early. Take the hit, take the loss, and because they could get worse. And it also frees up your time and your headspace to do more. Another thing I learned that I didn't leverage very well is seller finance. And I think that this recession, there's going to be even more opportunity, because you have people who are struggling to find the price they want for their house, but they have these 2%, 3% mortgages, and you can really cash flow with that, because that's what a third of the going rate, half of the going rate. So I would also take advantage of more seller finance deals. And the third thing, it may be too late for, is become more cash heavy. Make sure that you are setting aside money for all your deals for very long-term bad scenarios, and just set it aside in an account and don't touch it. And you probably won't, if you execute the deal well, have to use the cash, but having it there set aside, not taking it for another deal, can really help you stay in a good situation when those problems come up.
So, sorry, Roger, go ahead.
I think one of the biggest
Oh, sure.
takeaways that I've taken from knowing Ben all these years is when you go into development, you originally think that people come in with just huge amounts of cash, like millions and millions of dollars, and they buy this land betting that they're going to be able to develop it. And in truth, what we do is more of a close after the city actually approves it. So until the city actually approves whatever you're developing, you don't actually put any money into it other than just the permitting fees and the feasibility and stuff like that. And so you're not really like splashing millions of dollars of cash into deals. You're putting money into like the permitting stuff and then waiting and see if you get approval. And if you don't, the at-risk money is just, like 1 or 2% of the total thing. And if you don't get approval, you only lose like 1%, instead of having what could be like $1 million like piece of grass that's only good for like feeding goats.
Right, right. And so is that just like, do you make it subject to city approval and stuff like that? Or do you just like put it under contract for like 12 months?
Knowing your
Exactly.
timelines is really important, as well as being aware of how good the municipality is at excited about your project, how much they're going to fight against you. Cities have reputations for being developer friendly, developer not friendly. And so you have to learn that. And we've done both. We've done lots of 12-month contracts with 60-day extensions baked in. And we've done some that contingent upon the approval. It really just depends on how hard of a fight do you think it's going to be.
Right. Always seems to be like some sort of pushback. They're always going to have different codes, regulations, all that stuff.
So
It's all
now,
good stuff to know.
now
Yeah,
one of
the first thing I do on every single project, sometimes before I get it under contract, is I'll actually go into the city offices and speak with the development guy there and get a sense of how he feels about our project. He's not the final approval authority on almost anything, but he's the staff member that's going to go to the planning commission and go to the city council and make recommendations. And in theory, they trust their employees. That's why they work for them. So
Right.
having them on your side is tremendously important.
Yeah, that's great strategy. I like that a lot. If I can bounce back really quick, you mentioned kind of with the deal we're going to start seeing right now. Like you said, you got people locked in at 2s and 3s interest rates, and there's going to be seller finance deals. And kind of mentioned, it's Feds are trying to do like a soft landing sort of thing. You mentioned the word recession, and I was curious on your take or your forecast on what we're gonna kind of see coming into the next 2, 3 years. And I know nobody knows the future, but it's just interesting to get everybody's take on that.
I'm not an econ expert. My wife actually studied economics in school, and I'm very plugged into some people that are really smart about it that will text back and forth just to try to gain as much information as I can.
Mm-hmm.
But like I said, I wouldn't say I'm an expert. I think that the word recession is lost. They used to say that a recession means 2 quarters of negative GDP growth. And we had that last year, and now it wasn't a recession. I think most people on Main Street would say that we're kind of in a recession already. GDP is growing, but inflation is eating that up. Interest rates make it difficult to move, difficult to buy a home, difficult to buy a car even. And at the same time, credit card debt is skyrocketing. And so I think that when you talk to people, my experience is that they already feel a recession. And so I don't know if we'll have negative GDP growth, but we are going to have difficult times for regular people and regular investors.
Interesting. It's a good outlook.
I'd say there's a lot of house flippers out there right now that are already going through the things that are in a recession. So they've lost money on houses and they're, on the sidelines waiting for the market to get better, lost $100,000, learned their lesson. And now they're just sitting on the sidelines for what could be another, year or something and waiting to see, that they're guaranteed that at least interest rates won't go up during their house flip, or if they are going up, that they're not trying to chase it, that they're, baking that into their offer.
Right. My feeling
Sell
is
your
almost
dogs early.
Sell your dogs early.
I think that that's even more pronounced in the multifamily space, Roger. And I mean, you already have seen multiple major failures, people losing $50 million assets. There are actually companies, multi-billion-dollar companies, who've walked away from $150 million assets and just lost all their equity because they're looking at what their options are right now. And with cap rates going up and interest rates going up, as well as insurance has gone up tremendously recently for multifamily properties. And so they have less income, and then they have a balloon because almost all multifamily and commercial loans are balloons. And if you look at how many, I don't know the exact numbers, but there are massive amounts of loans coming due in the multifamily space where those operators, in order to meet their debt service coverage ratio, are going to have to bring in a lot more cash. And so you're looking and saying, okay, if I have a $50 million asset, I may have to bring in $10 million to buy that mortgage down to be able to refinance it. What are my other opportunities that I could take that $10 million and do something better? And so there's quite a few syndicators and large hedge funds that are walking away from assets. And we have at least another year of that continuing, because there's still a whole lot more maturing debt on multifamily assets.
And I believe those are based on what, 7-year loans, and then you got to refinance or something like that from commercial.
Yeah, it's a little worse than that right now, because there were a whole lot of syndicators, new syndicators, and some more experienced syndicators who were just snatching up multifamily assets in 2020, 2019, 21. And they often just have bridge loans that might last 2 years. And so now a lot of those loans are coming due, and they're even more expensive, and they're usually higher LTV as well. So you have to bring in more cash. So it is a little extra pronounced right now. And that's supposed to die off in about a year with upcoming maturing assets. But there's still a pretty good trickle every year thereafter with those 7-year balloons and things like that.
So could be some good deals out there in that space if you're prepared for it.
If you're well positioned with multifamily, then there's this is maybe the best time, certainly in my career in life, to buy multifamily assets. I heard Grant Cardone say in an article the other day that this could be the best transfer of wealth in multifamily in his entire career and life. And he said that you will have normal investors, Main Street investors, who are able to take massive assets from hedge funds, from multi-billion-dollar companies. And that's an opportunity that, maybe hasn't existed since the savings and loan bank era. So I think there's just great opportunities right now in multifamily.
So somebody like me, I've never flipped a house. I want to flip a house. That's on my to-do list. I want to get into, all the stuff you guys already do together, but still learning and need some time and stuff like that. If someone like myself or somebody like a younger person who's trying to get a piece of the pie, what steps would they take to reap the benefits of, some of this opportunity that's kind of unfolding in front of us?
One of my mentors, Rod Khleif, he says the very first thing you should do is find your superpower. On these big projects, you don't really have one person buying a $50 million apartment project. You need different specialists, an asset manager, investor relations, acquisitions, underwriting. There's a lot of different skills that every team needs. So I would be looking very aggressively for what your superpower is, and then networking to find where that superpower might fit in with an existing team, so you can leverage their experience as well and come in and get some equity and general partnership.
That's awesome advice.
That's good advice.
Appreciate it. Really good advice.
Why don't we switch gears a little bit? Right now, Ben, you're working on a couple of different short-term rental developments where you're finding land and getting the proper approvals and stuff, and then building to keep and rent. Do you want to kind of tell us a little bit more about that?
Sure. As I said earlier, my partner is someone I went to law school with, and our company is called Build Vacations. And it's something that we're very, very passionate about. And we have 2 developments right now that are single family homes built for short-term rentals in the Outer Banks, North Carolina. And those are under construction right now. Also have a project in Roatan that will be about 40 or 50 hotel units, as well as 40 or 50 homes. And we're currently in the process of getting our general plan approved, which is where all our lots are going to go. And as soon as we get that, which hopefully will be shortly here, we'll be able to start designing houses and finishing the design for the hotel. And we hope to be building those houses early next year and start on the hotel probably in the fall sometime.
There's a lot of people that will say that development is too risky. You yourself have said that, land is going to eat 3 meals a day. How do you mitigate the risk in that space, and what's the upside?
The upside is massive. It's very, very lucrative because if you can carry a project all the way through, you're making the profit of the person entitling it and getting it approved. You're making the profit of the developer who's building the utilities for that project, and you're making the profit of the builder. And so I think that most deals that we underwrite, that we get serious about, we're going to be about 55% LTV on the project. So they're good margins, and especially for a smaller developer, not a massive multi-billion-dollar company, that's about the target range that you want to be in. A lot of publicly held companies want about an 80% LTV, 80 to 90%. And so there's a lot of opportunity there as well to get something approved and then sell it to them and take that spread from 55% to 80%. And I've done deals like that where I own the land for less than 45 days and taken that spread. And so there's a lot of really good opportunity. The way that you mitigate that is because land does eat 3 meals a day. Unless you rent farmland, you don't really make any money off of it, and you're paying taxes and insurance and interest. And so a good way to mitigate that is to do anything you can to get around the interest, which is usually your largest cost. And so you can do that by structuring the contract so that you have things set up to either get going on building or to sell it to a big publicly traded builder before you close on the land. So you can really get it so that you don't own the project for a long time and you can get a good chunk of profit on that. But really taking down land and owning that land, that often called land banking, is something for the wealthy. And if you do that, you better make sure that you have reserves for a lot longer than you anticipated, because I've had projects, we had one self-storage that we did right before COVID is when we started the project. And as soon as COVID hits, city destaffed, they went remote, and it ended up taking us about 2.5 times as long as we had planned on getting approval. And our plan was a reasonable, well thought out plan, but we couldn't have predicted COVID and how that would impact the city's workload. And so really, worst case scenario is kind of what you have to plan on in development.
Yeah, conditional use permits are not nearly as good as permits that are already allowed and in place. Transit corridor being much better than conditional use in my experience.
Yeah, there are multiple stages in getting a project approved. The first one, and it's important to know and understand what your rights are and what your fight is up against. The major stages are entitlement, zoning. So zoning, annexing into a city, de-annexing from a city, that is almost always at the whim of the city council. Once you have that zone, so it's very risky. Once you have that zone, you're entitled to whatever the code says you can build. That doesn't mean that a project won't take a long time and have a lot of fights, because cities can slow you down a lot. And the rules and code are very complex. And so there's a whole lot of ways that they can drag that out. Your engineer can miss something and you might lose 10% of your units, or because you need extra parking. And so you're entitled, it's by right, but it's only what's in the code. So you have to learn the code as best as you can. And then the next stage after that is permitting. And permitting is, once again, by right. You just have to build what is allowable. And that's where, as Roger was saying just a minute ago, with conditional use is an entitlement, but there are some conditions that can be very difficult to get approved. And so permitting, especially on these big complex projects where you're building 200 units or something like that, those are difficult projects to get designed. And so that stage can also take a year or two, especially if COVID happens.
That's pretty crazy. I had to to kind of feel like I know what you guys are talking about. I had an experience with the real estate transaction kind of similar to this. Um, this was some property out in like Harriman, your very southwest corner of Harriman. It wasn't even part of Harriman, it was just part of the county. And had some clients, they wanted to build a pool and a detached garage. And it was like a 5 acre lot. And so went to the county, Salt Lake County, and it was like this whole thing it was like a conditional use permit. We had to go and get a survey of the whole lot done, and then you had to be so many feet from, you had all these setbacks, so many feet from the river, so many feet from the road. And I just remember we like extended the contract another month out. Earnest money went hard, and at the end of all of it, it was just like, well, it sounds like you can maybe do it. And that's all we really had to, and they ended up fighting and fighting, and they finally, I think I talked to them, and it must have been like 3 years now, but I think they just finally got everything approved to start doing their pool. But it was like a long, hard battle, is what it kind of seemed like.
Conditional use permits are spongy. The law in Utah, and most states are fairly similar, says that the city must approve it if you can find a way to mitigate all of the reasonably anticipated detrimental effects of the land. And there's another one that's a simple legal argument that there must be something unique to that property that is not economic in nature, is a rule in Utah. Not every state has that. But the spongy parts are where it says the reasonably anticipated detrimental effects. Well, what's a detrimental effect? What's a reasonably anticipated one? It might be parking, it might be ingress, egress, but it's very spongy. And so cities can really push back on that. And then you also have to mitigate those effects. And mitigate is also very spongy. Does that mean that you solve it so that effect is gone? Or does it mean you make it 10% better or 80% better? So they're very difficult if the city doesn't like what you're doing, or there's just a city engineer that's difficult to work with. It's very spongy.
Another thing you see a lot is the use and control of rainwater in catch basins and stuff like that. And sometimes they're like a shorter term for the, storm that might be the worst in 10 years, or they might push it up to 50 years. And then the question is how do you control that much water? How do you put a place for 100-year storm worth of water in the middle of your project that you're trying to build out as effectively as you possibly can? And then right there, smack dab in the middle, they want like this gigantic catch for a storm that may never happen in your lifetime.
We have a very difficult problem with that right now on our project, in one of our projects in North Carolina. About half of the land is wetlands, and it's an island, and we're right next to the wetlands and the intercoastal waterway. So the rule is that we can't, for that big storm, we can't let the water run into the wetlands or the ocean. And we're about 9 feet above the ocean in elevation. And they want us to be able to store enough water for that storm, not counting, because it's sand, right? Water goes straight through sand into the water table or the ocean at this point. But we can't use the calculation of how much water will go through the sand, which is considerable, during the storm. So we have to hold all the water that could come in that storm without factoring in how much water actually needs to be stored. And the problem is we're only about 9 feet above sea level, so we can't build very big basins. And so it's been really difficult in getting that approval. And we've submitted multiple versions of it as we get more and more comments back from the state of North Carolina. We're almost there, but finding how to design those basins can be very tricky depending on the contours of the land.
Right. It's almost like you got to start getting creative to find solutions as you're doing developments and different things come up like that. A lot of those things almost seem tacky, like it's just like they spitball you and then it's your problem to deal with.
Yeah, in a
But that's
storm
part of the
like that, over half of the water that rains will soak through the sand during the storm. And so we could really build catch basins half the size that they are right now and store all of the reasonably anticipated water that comes down during that storm. But we have to double the size of our catch basins to get permits.
Jeez, sounds tricky. Godspeed.
Thank you.
It's often frustrating when you go into the city council or whatever, and you start the permitting process and you get put into these DRT meetings, the developmental resource team, and you get all these stipulations for, building, and they take your plans that are well thought out and start redlining them and changing everything that you thought was going to happen. And then you have to go and circle back and have your engineer redraw them. And then you go back to the DRT meeting, like with, as much hope as you can possibly can. And then they redline them again. And you're just stuck in this vicious circle where you just want them to say, okay, here's your permit. And they keep, changing the finish line and pulling it and changing it and wanting to do all sorts of like land trades and egresses and stuff like that may not even be possible on your project.
That's crazy. And have you, either of you guys, and I guess maybe more Ben specifically, but ever had a project where, kind of what we've been discussing, you're in this never-ending loop of, okay, here's the new design, and then they slap your wrist, and then over and over and over again until you find out that you can't actually do what they're wanting to do. Have you ever been in that situation? And if you have, was there an outcome, or was it just like just kind of like took the hit or had to make big changes to the project?
I've never had that happen. I have had a project that was under contract, and the city of Saratoga Springs has very difficult development requirements. And we had the project under contract, and we'd gone through some red lines, and we pulled the plug on the project, so we didn't close on it. We would have eventually gotten approval. We maybe would have lost a few lots, but the timeline and the uncertainty just made us be more conservative. I live by Warren Buffett's first two rules: don't lose money, and see rule number one. And so we did lose some money on that for applications, and we even lost some earnest money, one of my bigger hits, but we didn't go into something blind and stuck.
Right. So do your due diligence, everybody. Make sure you know what you're getting into. Out of curiosity, did it have to do in Saratoga with property being near the lake?
It was right on the lake, but what it actually had to do with was changing requirements of water rights was the biggest one, as well as the city set a rule that said you had to buy water rights from them. You couldn't buy them off the market, and the price that they had set for those water shares were dramatically. I think they were 4 times more expensive than the market rate at that time. And there were some developers that sued the city over that. I don't know the outcome of that case. I imagine the city probably had to drop their price or take part in the market. But they also set some rules for public open space that were very unreasonable, maybe 2 or 3 times more than I've ever seen a city require. And we unfortunately were not at the stage far enough along in that process that we were entitled to the old rules, the grandfathered rules, which comes when you submit a permit. So when you submit a permit of any kind or a zone or anything like that, you're entitled to the rules in place at the time that you submit a complete application. And we hadn't gotten to the permitting stage of the project that allowed us to be grandfathered into those rules.
Yeah, I've actually heard a lot of negative things about Saratoga City. Seems like a difficult one to deal with.
One of the cool things about your company, Ben, is Build Vacations does syndications and deals that are in places where you would want a vacation. Me personally, as a syndicator, I've done quite a lot of stuff in New Mexico in like workforce service apartment levels where, we're never going to invite our equity, our LPs, the people that bring in money to come and visit, stay in these, they're nice little apartments, like $900 a month kind of thing. But we're never going to invite them out to enjoy this space and look at the project. Whereas Build Vacations, you actually even have deals in there that is, you're able to go in and offer people a way to invest and then also give them a chance to do a vacation there. Why don't you tell us a little bit more about that?
Yeah, that's one of the reasons we're very passionate about Build Vacations, because the only thing you leave this life with is the legacy and the experiences that you've had. And we like to say we do build on the upper end of the market in quality. And so they're great experiences. And we always say that we want to add money to your bank account and add experiences to your memory bank. And that's something I'm really passionate about. I love travel. I've had great experiences with my kids traveling and with my wife. And it's very important to us to help extend that to our investors so that they can be increasing their quality of life as well as saving for retirement and making a good investment.
Absolutely. The thing that we're harping on here is just you can't take your Lambo with you, but you can definitely create memories that will last forever, a lifetime with your family and friends.
We have good returns in our business. There are things you can invest in for a better return, but I've never known somebody to have a good experience with looking at their crypto account and the experience in life. Maybe they feel a little better about their financial situation, and that can help them have experiences in life. But there's a lot of uncertainty there, and people don't actually enjoy crypto.
Yeah, if you do enjoy crypto, watch out because it might drop tomorrow.
Or you might have the SEC coming after you and have a criminal trial, depending on what you're doing in crypto.
Yeah, they could come after you in the syndication space too, and might be through no fault of your own, but because the market has changed, interest rates have changed, cap rates have changed. And that's when a lot of people are going to have some real serious problems with the SEC.
I've actually avoided syndicating my whole career until about 2 years ago when we found this idea of Build Vacations, and I wanted to bring investors in with us. And the difference between crypto and a real estate syndication is real estate syndications are well-defined rules in the SEC, whereas crypto, they're trying to find out what those rules should be. and sometimes they will apply them retroactively. Whereas if you get a good attorney, if you follow the rules in real estate syndication, you will win the lawsuit at the end of the day, even if the market tanks and your investors lose money.
That's a good point. To kind of circle back to Anthony's question earlier, one of the ways that a newbie can participate in syndications or development or whatever is if somebody like a newbie brings in the idea or the deal or the land to the deal, and then they can partner as opposed to just being a realtor or a, wholesaler or finder fee or whatever you do.
Mm-hmm.
There are lots of syndicators out there that have tremendous amounts of money and operating experience, that their business model is based on crowdsourcing, finding deals. So they want people to bring them a deal, and then their experience and their access to capital allows them to participate in that deal with you. It's a great way to get started.
Yeah, I'm gonna kind of shift my mindset into 2024. I want to get more into real estate investing. That's something I've never really chipped into, but I learned a ton from you on this podcast, which hopefully our listeners did too, because that's really good info.
Yeah, thanks for having me again. It's been great.
Yeah, no, I appreciate it. Roger, that's a great guest you brought on. Really excited we got to do this. I'll wait for the final four. I feel like Roger has some other good topics to cover. But yeah, it's been fun.
Yeah, other than waiting for everything to unfold and making our predictions for the crystal ball of what the future holds, we're kind of just moving forward with things that we know and can control, and hoping that things are within the realm of feasibility and possibility.
Absolutely. Never do real estate in slow motion, because especially in a pivoting market like this, kind of like I said earlier, sell your dogs early. But every single thing you can do, especially if you're struggling with a deal, do it fast and do it hard.
Good advice. Good to know. I'm going to be looking for the deals. Sounds like they're coming up. I might be giving one of you guys a call one day when I find the perfect one.
So, Ben, you've done a trip to Costa Rica, a trip to Belize, a couple trips to Roatan. What are the things that you like about developing in tropical areas?
I love going to those areas, and I live in Utah. And so I love to get out there during the winter, which is when it's cold here in Utah and when people aren't going on vacation as much because their kids are in school. So that gives us some vacancy rates in those properties that we can take advantage of. But I also very much like the economics of those markets. There are a lot of people who might buy a house in Costa Rica to do short-term rentals, and it's really difficult to manage that so far away and really make it economically feasible and a well-oiled machine. And so one of my superpowers is development. And so it enables me to do larger projects that are centrally located and far away. That's a lot easier to manage than a small project. And so it gives us an opportunity to really take advantage of our strong points in a really cool location that will be able to get life experiences.
That's awesome. You can definitely capture some of the upside of doing the development, and then the economies of scale of doing more than one. And it's great for a passive investor because they're able to partner with you and work with you and make some of the money that you make using your experience. And then they also get the backside that is, when it's built, they can actually, take a little time and go and check on their property and do a business trip where they see what they're doing and also enjoy tropical temperatures when it's cold here in Utah.
Yeah,
If you live in
we do we do a lot of economic underwriting of the markets that we look at. I think we've looked at 95 to 100 markets, and we own in 2, and we're interested in 5 others. And so we've taken a lot to really underwrite the economic conditions of those markets that maybe an investor who's just buying a single house can't undertake that level of underwriting in order to buy that single house.
And as far as evaluating, different countries and economies and finding where there's little, compared to like the US where the scale is a lot smaller and you can do a lot more. What kind of approach do you take to that? Do you get a professional who that's their superpower, or is there a formula you guys use?
We'll hire a professional once we get a project under contract to give us a feasibility study. But we use a lot of brute force. There are things like CoStar and things like that that can give you a leg up and see what the hospitality markets look like in these other countries. But we use a lot of brute force as well, where we will pull up our competitors in the space and track for a season or 2, track their occupancy, their rates, and it allows us to have really good firsthand information that may not be available to the public, and it gives us another security blanket if somebody else isn't doing their job. We'll also look at, especially foreign, we'll look at the stability of the economy, the stability of the politics, and see what that country looks like, what the corruption is there, what the crime is there, just a lot of things like that working in a foreign country that can really bite you hard. I mean, look at Russia, and some American companies lost very large portions of their assets in the country because of a difficult to predict event. That those events will happen throughout our lifetime and throughout our investments. So the more we can predict that, the better off we're going to be.
Nice. I think it's a great approach. Hopefully I get to think back on this one day when I go and build my tropical hotel in Costa Rica. And I remember to do that. I won't say I hope. I'm going to say I will.
You will.
To do it one day.
VAs are a wonderful thing. They can help with that underwriting a lot.
For everybody, that's a virtual assistant, which we find a lot of those in the Philippines.
Final 4. Here we go. So we got 4 questions we ask every guest, and today is your turn, Ben. So let's start with question number 1. What is your favorite business book?
My favorite what?
Your favorite business book.
The Snowball. It's about Warren Buffett's life. It's a biography, but so much of Warren Buffett's life was business that there's so many gems in there that I've never found another book that had that many gems.
Nice. I think Warren Buffett's a good investor also. I mean, very stable, very smart, low risk, long-term outlook. That's awesome. I'm going to actually download that book today because I have some Audible credits. Question number 2, what brings you happiness?
Making meaningful experiences with my friends and family. I'm a big believer that my wife doesn't like it when I say this, but we all leave this life naked or broken alone. And, you can't take it with you. So no matter how much money I make in my life, it doesn't make a difference. I have to find peace in things that will last, and my kids and the experiences that we have with each other are enduring.
That's awesome. Experience over materialism, kind of the mindset. I like it. Question number 3. What does your future retirement look like, and or do you have one?
I have found so much joy in my work over the last 2 years that I've changed my outlook on that. And I don't see a retirement other than hiring a CEO, a CFO, a COO to help run our company and slowing down a little bit.
Awesome. And question number 4, what do you think is the best way to give back?
I think that time is the most valuable thing you can give. And the way to do that is to find something that is within your expertise and that you're passionate about, and find ways that you can give in that arena. So we have a daughter who has been suffering from cancer for about 14 months. And so it's something that we've learned a lot about, and we're very obviously passionate about it. And so we've found ways to serve that are hard for people who don't have my life experiences to do. So really draw on your life experience and your expertise, and you'll find a meaningful way and focus on that.
That is awesome. That is the final 4, Ben. Thank you for being on today.
Hey, thanks for having me.
Yeah, you've been an awesome guest. Actually, I'd say probably one of my favorite. I learned a lot from you. So, Roger, I'll let you kind of close things out, but hope everybody learned a lot and enjoyed the show. And thanks again, Ben. It was good to meet you.
You too.
Yeah, thanks for being on the show. Thanks everyone for coming and listening to our Retire Wealthy and Happy podcast. Once again, we've had Ben Lakey, who's a JAG and also a developer, specializes in short-term rentals locally, far away, and also in tropical areas. We also want to thank our sponsor, Monument Real Estate. Monument Real Estate, helping you cut your retirement goals down by 5 to 10 years. Thanks everyone for joining the show. Thank you, Ben. Thank you, Anthony. We'll see you on the next episode.
Hope you got value from this episode. And if you have a minute, then take the time to leave an honest written review for the podcast, because we take those reviews seriously, and it'll help us serve you better on the next episodes. And most importantly, be sure to start taking action so you can control your financial future today.